Hey everybody, I'm here to discuss a company called Genpact Limited, ticker symbol G. This company is a smaller mid-cap size company with about a $5 billion market cap. The stock is down about 30% over the past year. It's down about 40% from its highs. I'm one that likes to research all kinds of companies in different industries. Like to look at small cap stocks, micro cap, mid cap, large, doesn't matter. And I'm trying to find companies that are trading at really good value. And certainly this stock is trading, in my opinion, at a significant margin of safety, but there are certainly risks that come with this stock. So we're going to go over this particular company here today. So like other stock analysis videos I do on this channel, I really break it up into four different sections. So we have, first the business overview, what does the company do? Do they have any competitive advantage? And what are the risks associated with this type of company? Two, financial overview. We're going to be looking at a 10-year financial history for this company. Number three, stock valuation. We'll be looking at a couple of different valuation methods to determine what a fair value and a good buy price for the stock might be. And number four, what would be the return on investment I would expect from this stock based on some assumptions we make in this video. So let's start out with the business overview now. So according to their 10K for 2022, their 2023 10K hasn't been released yet. I expect to see that probably over the next month or two. But the business overview in their 10K says this: Genpact is a global professional services firm that makes business transformation real. They drive digital-led innovation and run digitally enabled intelligent operations for their clients, guided by their experience over time running thousands of processes for hundreds of Fortune Global 500 companies. They have, as of the end of 2022, about 119,000 employees. That's over 125,000 now, serving clients in key industry verticals for more than 35 different countries. Their total revenue for 2022 was $4.4 billion. So that's great. I always like when I read the 10K, and a lot of times I'll read their business overview, the first paragraph or two, and I'm like, that still doesn't tell me exactly what they do. So let me kind of just give it in layman's terms on exactly why what this company does and why they're needed in the market. So Genpact really helps our clients identify pain points and develop solutions to improve their efficiency, effectiveness, and their agility in the market. So for example, maybe it's a company that says, hey, we want to improve our margins. Let's hire Genpact to come in, have their expertise looking at our business model and figure out where we can maybe cut out some fat and improve our margins. And so Genpact will come in, they'll look at their operations and say, hey, you could combine these two areas. Hey, maybe you have your accounting divisions in different states. Maybe you just combine all into one. And so they kind of work through on how to improve their business model just in general. They also do provide expertise or experience in certain positions. So maybe on a company, you need some kind of like temporary help, even potentially maybe long-term help, maybe like a CFO position or something like that. They could leverage Genpact to kind of fill those roles as well. And they also partner with some very, very high-end companies, such as Deloitte, which is a large accounting firm. They also partner with Automation Anywhere, Blackline, and a lot others. So, it's just not their, people within their business. They're also leveraging their partner base in general to help these companies grow and become more efficient. So the company is split up into three different operating segments. So they have their financial services, which is about 27% of their revenue. They have their consumer and healthcare division, which is about 35%. And then they have their high tech and manufacturing business segment, which is about 38% of their revenue. From what I looked at, the high tech and manufacturing segment has been growing a little faster than there's other business segments. So on their website, there are actually a number of different case studies where they've helped their client improve their operating efficiencies. And so one of those case studies they have on their website was a manufacturing company that was kind of in the snacking business. And they brought Genpact in to really look at their business model and really try to understand if they can improve their efficiencies on the bottom line, especially in a business that is experiencing a lot of volatility and they're having a hard time predicting the demand for the different products they have. So Genpact came in and they were able to improve their inventory balances and they were able to help the company forecast a lot of the demand in the short and long term, which really helped the company hone in and focus on inventory levels, which reduced their inventory by almost 20%. So by doing that, the company was able to create not only cost efficiencies, but they're also able to reduce their cash flow going out, improving their overall free cash flow. So the market Genpact is in is actually predicted to grow at a 9% CAGR over the next 5 years through 2027. This is according to the Gartner research, which I found on the CFRA research report. The specific market that they're in is called the Business Process Services, or the BPS market. So according to Gartner research, they do think there's going to be some significant growth going out into the future. However, here recently, we've actually seen some of the demand slow down. The reason why the stock has fallen almost 30% over the past year. However, it is really important to note that the company had strong bookings and steady win rates of 60% in 2023. They had a lot of positive momentum around large deal signings, about 14 clients with over $50 million for the contracts they signed. Formed in 2023 with net bookings up 25% to $4.9 billion. And to put that in perspective, the company did roughly $4.5 billion of revenue in 2023. So with net bookings of $4.9 billion, I mean, that covers about a year or more's worth of revenue, which is really good for this type of industry. However, their top line growth has slowed in 2023 and is expected to be slow in 2024. From 2023, it was only up about 2.4%. Something else to note is that they have a management team that has really been with the company for a very long time. So one of their founding members, his first name is Tiger. He's been with the company for over 2 decades. And just recently, he stepped down from being CEO and now he's part of the board, but he's still with the company. And in his place, Balkrishan Kalra, hopefully I'm saying his name right, stepped in as president and chief executive officer, and he's been with the company for almost 2 decades. So it's certainly not a management team that turnovers a lot, which is good. So what are the type of risks involved in buying into a company like Genpact? They actually have all their risk factors in their 10K, but I'm just going to highlight a couple of them that I found. One of the risks that jumps out to me is the return that the company has had over the last decade, and this came right out of their 10K for 2022. So they actually compared a 5-year return for Genpact, S&P 500, and also their peer group. And you can see the top line is the peer group, and they have outperformed Genpact as a whole. This would include WNS, this would include Accenture, and even Genpact has lagged the S&P 500 from 2017 to 2022. However, it's important to note that there's been some pretty big swings from year to year. So for example, in 2018, the company was beating the S&P 500, while in 2021 and 2022, they failed to meet the S&P 500 returns, and certainly have lagged the peer group pretty much the entire time over the last 5 years. Another risk, I think, with buying into this company too, with a new CEO coming on board in 2024, is that going to impact the company negatively? On the surface, I would probably say no, because the CEO has been with the company for almost 2 decades, and the founding partner who ran the company for almost 2 decades is still on the board. So I still think, there should be a lot of continuity between the two. So I don't see a major impact there, but it is certainly a risk to consider. Another risk to consider is actually acquisitions and mergers for the company, and really leveraging AI moving forward. This company actually started with General Electric back in 1997. That's when they really formed this particular part of GE's business, but they spun off GE back in 2005, and they became listed on the New York Stock Exchange in 2007. But the company's been through a lot of transformations over the last, 5 years by building different partnerships and strategic acquisitions. So if those acquisitions don't turn out well, it could significantly hurt the company. Not only that, but they are leveraging artificial intelligence very heavy. And I think there is a view from the market right now that artificial intelligence could hurt a business like Genpact just in general. Will artificial intelligence actually take away from the business going forward? I actually have a different thought to that. And I think, with the company leveraging artificial intelligence, they can actually provide better data, quicker data to their clients, which will only help their business. So I actually think artificial intelligence is going to actually help the business more than actually hurt it long term. But if that's not the case, that's certainly a risk to consider with this company. Okay, so next, let's talk about the financial history for the company. We're going to go over a 10-year history for this company. We're like the big five: the sales, earnings, free cash flow, book value per share, and then return on invested capital. And I really like to look at the per share approach because it factors in any share issuances and share buybacks for the company. We'll also be taking a look at some balance sheet metrics as well. So let's go do that now. Okay, as you can see, over the last 10 years, the company has grown from a $4 billion market cap to roughly $5.5 billion here today. Now they got up to almost a $10 billion market cap back in 2022. And as we've seen that the stock price has fallen 30% over the last year, of course, in corresponds to that, the market cap has fallen as well. Now, sales per share goes, the company's seen 10% growth per year on the top line over the last 10 years, which is really, really impressive overall. Earnings per share has grown 17% per year. Free cash flow has grown 11% per year. You can see book value per share grow at 9% per year. And return on invested capital has averaged 11% over the last 10 years. So these are actually very, very impressive numbers on the top line, bottom line, very consistent across the board. However, you can see over the last 3 years, we've seen free cash flow take a dip by 4% per year, which is another reason why the stock has fallen. But from a 10-year basis, it's grown 11%. Next, let's take a look at their debt situation and really the balance sheet just in general. Now, their long-term debt payoff, so this column right here is really looking at how long is it going to take for the company to pay off their long-term debt based on their free cash flow? So I like to see under 3 years, and currently it's at 1.9 years. So that is excellent. And even over the last 10 years, their long-term debt has been pretty reasonable. Now their debt to equity, so that's total debt to total equity, right now is at 67%, which is really good. I like to see under 75%. So from a debt situation, that they look like they're in pretty good shape, and that is even with their acquisitions that they've made over the number of years. And you can see they've been paying down their debt, which is fantastic over the last couple of years. Now their current ratio, which is looking at working capital for the business, is at a 1.4 right now. So they have plenty of current assets compared to current liabilities. And they've averaged a 1.6 over the last 10 years. So it's been very consistent, very conservative. So when I look at these metrics, their balance sheet looks like it's in pretty good order right now. And lastly, let's take a look at what the company has been paying from a multiple standpoint and how well their margins have been over the last 10 years. So as far as a multiple goes, I'm looking at a PE for the company. Right now it's trading at a 10. Historically, over the last 10 years, it's been an average of an 8. So according to this, it does look like it's undervalued just looking at a PE standpoint. But that's not the only thing you should be looking at. It's much more important to know what the company's doing going forward than looking necessarily back on a particular company. Now, as far as margins go, very consistent overall. They've averaged 37% over the last 10 years, gross margin, and 13% for their operating margins. And actually, over the last 12 months, they've been at 35% gross margins and around 14% operating margins. So their operating margins actually have gotten better over the last couple of years. So they've been actually more efficient. So even though we've seen free cash flow take a dip over the last year or two, their operating margins have stayed consistent, which is really good. So here are all the numbers in one snapshot right now. So overall, I like to see that the company's been growing double digits on the top line, bottom line, return on invested capital has averaged over 10%, which is awesome. Their balance sheet is in fantastic order right now. Their margins have been very, very consistent over the last 10 years, and like to see even operating margins even improve during that time. So I'd certainly say this is a B plus or an A minus from an income statement and balance sheet and cash flow perspective. The company seems to be doing a lot of right things, paying down their debt, improving their operating margins, and continue to provide a good return on investment from their capital. I also mentioned the company is very shareholder minded as well. They've bought back almost 20% of their stock over the last 10 years, and they've been increasing their dividend, including this last quarter, by 11%. So the company definitely seems to be doing a lot of right things. So next up, let's take a look at some valuations on Genpact, determine what a good fair value and potentially a good buy price for the stock might be. So the first one would be a margin of safety calculator, looking strictly at EPS. Next one is a discounted operating earnings model. The third one is a 10 cap, which looks at owner's earnings. And the fourth one is payback time, which looks at free cash flow. So number 3 and number 4 on this list, so 10 cap and payback time, I learned from Phil Town. And I've incorporated those into my valuations because I do like the way they look at the different companies and look at different aspects of the company to determine what a good buy price might be. So the first one we're going to take a look at is the margin of safety calculator. This one, basically what you want to do is come with a good earnings per share for the business, where they're going to be at as far as growth from EPS over the next 5 years. Using a long-term treasury discount rate, I could come up with a growth multiplier and an EPS multiplier. And from there, I get a good target buy price. So I come with a 3.5 for EPS, so $3.50. I think growth for EPS will be about 9% per year. That is very consistent where they've been as far as their book value per share growth has been over the last 10 years, and slightly below where their earnings per share growth has been over the last 10 years. So based on this information, I come with a target buy price of $32. And today, the stock is trading at $30 as I record this video. So this particular valuation does suggest it is a buy right now. Next valuation model that I want to take a look at, and this is one that I created myself. This is my discounted operating earnings model. So with this one, I project revenue out over the next 5 years. I project out operating margins for the business over the next 5 years. From there, I can get an operating earnings growth over the next 5 years. From there, I get a net present value of future operating earnings. And then coming up with a good market multiple, I can come up with an intrinsic share price for the stock. So let's start out with revenue first. So the company came in at $4.5 billion in revenue in 2023. So I think that's going to grow to $6.4 billion in 2028. That's roughly a 7% CAGR on the top line. Keep in mind, over the last 10 years, they actually grown double digits. So I think from all the research I've done, it's going to be a slow year for the company this year with only 3% growth, and then it should pick up in 2025 and beyond. Next up is operating margin. So in 2023, they came in at 13.9% for operating margins. I think that's going to be pretty consistent over the next 5 years. So I'm using a 14% operating margins through 2028. So that gives me operating earnings per share of roughly a 5 in 2028. So based on this information, I come up with an 8% CAGR for operating earnings over the next 5 years. Now, I think a good market exit multiple for the company is an 18. This is based on historical averages that the market has been willing to pay over the last decade or so. Based on this information, I come with an intrinsic share price of $44 here today. And again, the stock is trading around $30. And if you're curious on how to value companies and how to use a valuation template like this one, I do offer this template and my other templates on my Patreon if that is something that you're interested in. On Patreon, I show you exactly how to use this model and the other models, so that way when you do your own research, you can go value companies yourself. So if you're interested in something like that, I'll put a link in the description down below. All right, so next up is the 10 cap valuation that I learned from Phil Town, which he learned from Warren Buffett. So for this one, we want to come with owner earnings of the business. In order to do that, what we need to do is first come up with a good free cash flow number for the business, which I come up to about $450 million. Then we want to add in the taxes the company is paid for to get to the total owner's equity of the business. So I'm coming with a total of $600 million of total owner's equity. Based on shares outstanding of 181 million, owner's earnings per share comes to about $3. Now we want to multiply that by 10. That's where the 10 cap comes from. When we do that, we come with $33 for the 10 cap valuation. So according to this model, it does look like it is a buy right now. All right, so last but not least is the payback time calculator. So this one and my discounted operating earnings model are my favorite valuation models that I personally use. This one strictly looks at free cash flow of the business, projects it out over the next 10 years, and then tells you when you would get your money back from the business after putting in. And the idea is you want to try to get your money back in 8 years or less, because then it would indicate that it potentially could be a good buy right now. So just like the 10 cap valuation, I'm coming with a free cash flow number of roughly $450 million for this business. I think the growth rate for free cash flow will be around 9%. Based on the information, I come up with 8 years for the payback time. So that is right on line where we want to see it, suggesting that it could be a good buy price here today. So here's a valuation summary from all those models we just went over. So my discounted operating earnings model suggests is a fair value for the stock at $44 here today. A 30% margin of safety would put a $31 buy price. The payback time calculator suggests buying at $30. 10 cap suggests buying at $33. The margin of safety calculator suggests buying at $32. So all these models suggest it is a buy right now. So next up, let's talk about return on investment for this stock. And this is basically my best guess on what I think returns would be if you bought into the stock at specific prices. So before I show you the actual return on investment for the different stock prices, let's just real quickly go through my assumptions one more time. So I think from a sales CAGR perspective, I think the company is going to grow roughly 7% per year over the next 5 years. I think operating earnings is going to grow roughly 8% per year. And a good exit market multiple for the company is an 18. The company does pay a dividend right now, and they just increased it by 11%. Right now, the current yield is roughly 1.8%. The return on investments that I'm going to show you guys do not include the dividends. So just keep that in mind. So here's the return on investment, what I would expect. So for example, if the stock was at $36, I believe it would be about a 15% return on investment per year over the next several years. Or if the stock's trading, say, $29, today it's trading around $30 roughly, I would expect a 20% return per year over the next several years. But keep in mind, these are based on these assumptions we just went over. So if these assumptions are incorrect, the company doesn't do this well going into the future, it will significantly impact the stock price. Because keep in mind that stock prices are really a representation of all future earnings. And that's also why when you're buying into a company, it's much better to buy at a margin of safety or well below the intrinsic value because, again, these are all assumptions, these are all forecasts. So hopefully I'm right or you're right when you're looking into the company, but certainly nothing is guaranteed. But I would certainly love to hear from you guys. What do you think about Genpact? Do you think it is a good value here today? What do you think about my assumptions just in general? I'd love to hear from you guys in the comments section below. Thank you so much for staying all the way to the end of this video. Now, if you would like to support the channel, I do have a Patreon. Through that Patreon, you get access to my valuation templates like the ones I showed here today on this video. I show you exactly how to use those valuation templates yourself so you can go out and value companies on your own. I also provide all the stock analysis workbooks that I go over on my videos. So, for example, this Genpact workbook that I was showing here today, I will also provide so you have it for future reference. You also get access to my Discord channel where there's over 100 different value investors on there, and you get access to my Patreon only posts. So if you're interested in something like that, I'll put a link down below. Now, if you're not interested in that or you can't afford anything like that, you can just help out the channel by liking this video, sharing this video. It means the world to me. I thank you so much for the support that you guys have given me on this channel. And I'm just so blessed to have so many viewers. Thank you so much for watching this video all the way through again. I'll catch you on the other side. Take care and God bless.